Hey, everybody. Thanks for joining us today. We have an awesome loan officer with a great background, Drew Shade with Nordic Home Loans. Drew, if you could take a minute and introduce yourself to our audience.
Hi, everybody. Drew Shade, Nordic Home Loans. I have been in lending. I started in lending in 2005 when I graduated college, and there was about an 8-year span there when I also was a financial planner. I have always loved lending and came back to it in 2016 and became an independent broker in 2019 and haven't looked back.
I love that. So, for our audience benefit, I know this, but for our audience benefit, you have some pretty deep knowledge about financial planning, right?
I I do. I mean, I don't know. I
Oh, you
guess
don't
from
have
my
to be
perspective,
humble
I know
on
people
here.
who have way more than I do, but compared to the average bear out there, yeah. I went through the certified financial planner curriculum. I never sat for the exam, but I took all the courses for it. 8 years in the business, and I was lucky enough to really be taken under the wing of pretty brilliant people who taught me some, pretty amazing things about investing and financial planning that most financial advisors aren't aware of. So, uh, very, very lucky and fortunate in what I was able to learn.
And you apply that today to doing reverse mortgages.
I do. I applied to doing all mortgages, but specifically reverses because reverses are the most underutilized, misunderstood, powerful financial planning tool out there. And the irony is that the vast majority of the public and even financial professionals don't understand how much power they have sitting right there that they're just ignoring.
Huge. It's the largest asset for most people.
It is, yeah. I mean, I've seen that stat. It's, for the average American retiree, it's like 2/3 of their net worth. And the ability to leverage that and strategically use it, having your cake and eating it too, because basically without this, the only way you can access the equity in your home is to sell your home. Then you're still left with the problem. You still need a place to live. You still need a roof over your head. So being able to have access to that wealth that's been created over 20, 30, 40 years, um, but then also not having to give up the house itself and the utility of the house. It's I hear this so often when I talk to people who've never really understood about reverse mortgages. I always know I did a good presentation when I hear somebody say, like, this sounds too good to be true. And I hear it literally almost every time I talk to an audience about reverses.
Isn't it funny? They go from, oh, that's the worst thing in the world to, it's too good to be true.
Yeah, it's amazing. And the amazing thing about that is that it's not because I'm telling them some sort of crazy falsehoods or some outlandish one-off story. It's like I just lay out the facts, and when they actually sit and dissect the facts on it, all of a sudden their opinion of it is a total 180. So it's the myth that persists that it's, oh, I heard those are bad, or I heard some story on the news about some lady this, and oh my gosh, it's so awful. And then it's like, okay, but when you actually take 15 minutes to really learn about it, and that's all it really takes to get a basic understanding, that I've never had anybody be like, oh man, those things are still really horrible. You've not convinced me of this. Everybody who's taken even a little bit of time is like, oh, okay, I totally misunderstood how these worked. I totally thought, I thought you signed away the title to your home and they take your house away. And I thought, these are, all these people foreclose on these things. And it's all whatever's been amplified by the media, to sell, the next. Nobody's going to tune into the news to watch the story about the, hundreds of thousands of people whose retirements have been improved. They hear the story about so and so got foreclosed on, and oh, they had a reverse mortgage, and they don't dig deeper to realize, well, okay, well, that person didn't pay their property taxes, and if you don't pay your property taxes, the county's going to foreclose on you. It's not the reverse mortgage didn't cause them to not pay their property taxes. I find stuff like that. That really, really like irks me and lights a fire because it's such a it's just such a misrepresentation of the facts,
Mm.
and it's because it's an easy sell. It's easy to paint that narrative of like, oh, this is this person got a reverse mortgage and now look what happened. And they never tie the two together. They never say that the workers cause it. And it's certainly never the person's unsustainable retirement that, they blame the last thing they did, even though it had nothing. And this is a good analogy that I told somebody recently. My grandfather had kidney problems, right? He got a kidney transplant. He lived for like another 7 years, and ultimately he died. But we didn't blame the kidney transplant for his death. The kidney transplant gave him an extra 7 years with us, and we're super thankful for that. We didn't blaming a reverse mortgage would be like us blaming his kidney transplant. Um, yeah. So I get super fired up when I hear stuff like that because it's lazy. It's just lazy reporting and lazy, hey, let us tell you what you already know, even though it's wrong, and let's just reaffirm that instead of taking a little bit more time to explain to you the truth. And now I'll
I've
get off
talked
my
about
my preachy high horse about that. But
well, no, I mean, other people on preachy high horses. We were talking about a certain celebrity before we started.
old Dave, yeah. You want to dive into that?
You had some really good sound bites. I think you've got some really good content that people need to hear because it's, we were talking about who he targets, and that's typically also the reverse mortgage crowd. It could be in the
It could,
past.
yeah.
Yeah.
It traditionally it is, and I'd like to see us not necessarily move away from that, but move away from it only being that. So Dave Ramsey is who we were talking about, as somebody who worked as a financial planner for many years. I have a lot of gripes with Dave Ramsey. I feel like anytime I ever bring him up, it's like people are so scared of him or scared to kind of say the emperor has no clothes. Um, because I'll talk to people who will say, "Oh, he's, yeah, I don't agree with what he says, but man, he's got some really good stuff about like, not living beyond your means." And I like that's not like a revolutionary novel thing that he stumbled upon. Like I think most people know that you should not spend more than you make. That you should not rack up, credit card bills at 30% interest, buy like expensive shoes, stuff like that. Like that's not revolutionary thinking, but people will say like, oh, that's he's really good about that. The stuff that I have problems with are a lot of his investment advice is really pretty not good, terrible. We talked about he has this view on debt, like all debt is bad. Um, and if you stop and think about that, like think about the fact that Apple, like one of the most like the biggest companies in the world, issues debt because sometimes borrowing money is the most effective way of raising capital. Um, and when Apple does it, it's strategic leverage. But when Dave Ramsey's clientele does it, it's debt. And so I look at things like what if you had hopefully, now interest rates are a little higher than they were a couple of years ago, but the vast majority of the American homeowning public has an interest rate at a pretty low percentage on it. And if they're listening to Dave, he's telling them to take all their extra money and pay that down, pay it off so that they can avoid paying, you know, it might like 3% interest. And what I think about is what if they took that money and instead put it in a Roth IRA where it could grow tax-free for their retirement? And when you actually do the math on that, person who does that, who say they had an extra $500 and they had to choose whether to pay extra toward the principal or to invest it in a Roth IRA, when you look 20 years down the line, person A, if they added $500 a month to their mortgage, would have it paid off. But person B might have like $350,000 in a tax-free account that they can access. And I would be willing to bet, well, because I've done the math on it, that 350 they have in that account is a lot more than they have left on their mortgage. So they're going to be hundreds of thousands of dollars ahead. And I find it shameful that it's an easy sell. It's easy to tell people debt is bad. And his target market is not the sophisticated, it's not the people who can afford to pay a fee-only financial planner to give them quality advice. And I think there's something kind of inherently wrong about that he, kind of sells kind of the lowest common denominator advice, and it's not great. And he's, as we talked about, Dave Ramsey is super, super rich, but he's not super rich by following Dave Ramsey's investment advice. He's super rich because he's good at selling it to people. His income comes from selling that advice, not from following it.
Right. Right. And
Yeah.
he doesn't make money if people do or don't follow it and succeed or don't succeed. He makes his money from the initial advice and then he's out of it. And
Yeah, he makes his
frankly,
money selling books. He makes his money selling airtime. He makes his money, unfortunately, and I think this is pretty lame. Referral partnerships. So financial advisors or real estate agents have to pay a fee to him to be like a Dave, approved person. And
Mhm.
the amount of money he charges those people, uh, in turn, right, they're going to have to pass that expense on to the client. And so it's hard to tell people to save money, save money, save money. And then if you go to a Dave Ramsey, referred real estate agent, that agent is probably going to have to charge you. You're not going to be getting a discount because they have to give such a huge cut to him. Um, yeah, the double talk I can't stand. And then his thoughts on reverse mortgages. It's the same thing I said. It's so lazy. It's so I can't technically call him a bald-faced liar, but it's so misleading and so like outdated that it the intent is certainly dishonest. Or at least if he believes it, he really has not done his homework and he shouldn't be out telling hundreds of thousands of people stuff that's just like patently not true.
Right.
Uh,
It's just a lot of the advice that I hear from him is a little sensationalized, a little dramatic, because that gets attention. And then it's also really blanketed. You know, the reverse mortgage is so customizable. It is so well suited. And this is why we get the comments of, hey, this is too good to be true. Because it can be so well suited and tailored and customized to the exact retirement needs. And he focuses on, well, they might not pay their taxes and they might not pay their homeowners insurance.
yeah,
Well, they might not pay those whether they have a mortgage or not, or whether they have a conventional mortgage or a VA mortgage or an FHA mortgage. Like that is all still possible as a homeowner.
yeah. Well, one thing that he says that I really can't stand is that he tells people, well, the interest rates on these things are double a traditional mortgage. And again, I guess technically, if you went back to like when rates, because are you in agreement? Like rates on a HECM are usually like maybe a half of a percent higher than your traditional 30-year fix, right?
Pretty much what half
Yeah,
half a percent to a percent, depending on the point in time.
yeah,
It's not crazy. And frankly, a half a percent or a percent to have no mortgage payment required.
yeah. To me that's a pretty good deal. He's saying it's the rates double, and I'm like, well, I guess maybe if when rates absolutely bottomed out, I think you could get like a 1.9% on like a 10-year fixed. And uh, on a HECM, maybe the rate was say four, like or in the four
So
or in the threes or somewhere around there.
I
So at
remember that point in
once
time.
at one like microscopic point in time, even then his thing saying they're double is still he's
They
still a
weren't
little off.
though. I
And they were
remember
yeah,
that point in time because my friend's little brother moved to a state I wasn't licensed in. And she goes, he got a 1.99 30-year fixed. Can I get that? And I'm like, how? And because I was doing reverse and I looked at my reverse rate sheets. And as a broker, right, we don't have a lot of costs overlaying onto the client like you were talking about.
sure.
There was a 2.03 reverse mortgage at that same
Huh.
time,
Okay, so
right?
there you have it. So then let's just call it what it is. Like I was trying to say, okay, he is misinformed. He is spewing out some falsehood. The
Right. He
rates on
might
them
be
are
looking at the
not double.
most expensive lender,
Yeah,
right? Or the most expensive program. But you know what? If we're looking at the jumbos, the proprietaries, we should be comparing that to the jumbos and proprietaries, the non QMs. And those rates aren't that different from each other,
they're not. I mean, I looked at them today because I had somebody needing a non-QM loan. They are pretty much identical. Yeah,
right?
yeah. So
Really, really good info.
there's that one. I mean, but there's another one where he talks about the foreclosure rates
Oh,
and
okay.
default rates. And so I think where he's really dishonest there is he talks about defaults. So maybe we should refresh everybody's memory. How do you default on a reverse mortgage?
Please.
You, you default if you do not pay your property taxes or your homeowner's insurance. or if you let the home fall into a state of true disrepair. But the other one too is, and you could make the argument that maybe all reverses are technically designed to default, is you no longer live in the home as your primary residence, right? Like, and oftentimes that's, I've heard people say you either leave horizontally or vertically for the last time. But explaining that to people that, okay, at that point, right, you're no longer meeting the obligations, but that doesn't mean that the reverse mortgage company shows up and the sheriff shows up and puts a notice of foreclosure on the door, but he leaves that impression of like, that's what happens to these people.
Well,
And
and can I add something to that?
yeah, absolutely.
So one of the conferences I was at, somebody was speaking on stage and they were saying that's the natural process of closing out a reverse mortgage when there's no heirs to be found to handle it. And a lot of people who have absolutely no heirs think a reverse mortgage is a good fit. It is a good fit for those people and a bunch of other people. But
Yeah.
some percentage of the population, that's the natural course. So, of course, foreclosure sounds like a dirty, nasty word, but it's just the name of the process to close out the mortgage and get rid of the property in whatever manner that is. And when it goes to Heckham and HUD, it's a foreclosure, guys. That's the language used. It's not a bad thing.
And exactly. But the problem I have with him is he does not take, how long did that take you? 30 seconds to explain that? He doesn't explain that. He leaves the impression that a 98-year-old person is getting kicked out on the street, and the sheriff came and evicted him from the house, and it's like that's not what's happening. I mean, if we delve into it deeper, like if somebody misses a uh, property tax payment, right? The lender does not want to default, foreclose, and right, as far as I know, and I've read in my studying to take the CRMP exam, they're going to make that first payment, right? They're gonna contact the client and say, hey, this happened, we've paid it for you, how can we get you current? We can set up a payment plan with you if you don't have the funds to do it. I mean, they're really, really, really not wanting seniors to lose their homes. And that's again, he talks about it like it's this predatory thing, and it's like it's it's the Federal Housing Administration, like the US government is not in the business of evicting seniors from their houses. Like I can't believe that he is, if you look for advice on it, like that's where you are going to end up. If you go on, most platforms, you're going to end up hearing from him, and his advice is just horrible. And the stats he uses of like the rates of default, they're super outdated. They're from like property tax defaults. They're from prior to having financial assessment.
So over a
So
decade old.
yeah, so if you go back a decade, FINRA said that they should only be used as an item of last resort, and there was no financial assessment. So if that's the case, then the people who are taking out reverse mortgages at that time are overwhelmingly people who are already in trouble, right? Their retirement is already unsustainable, and this is the last resort. And it's that band-aid on a bullet hole thing, right? Like it stopped it for a while and delayed, but inevitably, right? Maybe they ended up to where they, that unsustainable retirement, they bought themselves 8, 12 more years, and then it caught up to them. But I forgot what my main point was there.
The old information, FINRA
The old
changed.
information. So we have that segment, and then we also have that those people were not required to pass a financial assessment to make sure that they did in fact have the means to make their property tax and insurance payments. So that would be like saying seatbelts don't work and your sample size is only people who drive drunk. Like maybe that's not the nicest way to say it, but that's not a scientific sample size. It's super outdated, and and if you look at what has happened to default rates since financial assessment went into place, they've fallen by like 80%. So
that's huge. Okay, for our
yeah.
audience who doesn't really understand, you really do understand the FINRA stuff. And I don't have any other videos on this channel
Okay.
about that. Can you kind of go into the FINRA changes and why financial planners are often told, hey, check with your financial planner about a reverse mortgage, but why they may not be well equipped to actually handle those conversations?
Yeah, absolutely. So FINRA, most people have heard of the SEC, the Securities and Exchange Commission. FINRA is the Financial Industry Regulatory Authority, and they really are more like the boots on the ground, as far as uh, like compliance for financial advisors. And up until 2017, I believe, they had language saying that reverse mortgages were really to be used as an item of last resort. What happened was a man by the name of Barry Sachs wrote this research paper where he tested different theories with reverse mortgages, particularly using home equity strategically following a poor performing year in an investment portfolio. So the thought being that instead of, say your portfolio dropped 30% one year, instead of pulling out your income from that year, which you're going to have to sell more securities and it really is going to put strain on it, leave that money or invested, take money from another source like the equity in your home, and allow those funds to remain invested and take part in the recovery. So, and Barry Sachs, just to give you kind of like his abbreviated CV, he's got a JD, I think, from Berkeley, PhD, I want to say from MIT or Harvard. Like he has the most impressive, like he's not just a lawyer, he's also like a PhD in I'm not gonna remember what it is, but I mean he has like the alphabet soup after his name, and the institutions that he received those degrees from are rather impressive. Likewise, Robert Merton is a Nobel Prize winning economist, and he same thing. He's saying like this is going to be the future is using home equity. So anyway, back to the FINRA thing. His research was so compelling that FINRA removed that language from their guidance. So it's no longer there. They no longer say it should be used as an item of last resort. I think a lot of problems we find with financial planners, though, is that their broker dealers like didn't get the memo. So I have people who I talked to in 2021, and they're like, "Can you email me on my personal email about this because this came up in an audit with my broker dealer, and we're not supposed to be talking about reverse mortgages." It's like, you know, it's been like 4 or 5 years now since that was removed. You can talk about them, and you're really. I've heard the argument made like as a fiduciary, if you're not educated on this, you could like potentially have some sort of liability for not bringing it up.
Yeah, I think one of the other researchers, we have, financial planners, we have researchers that do this. Jamie Hopkins, he just put out an article about how it's likely that financial planners will actually be sued for ignoring the largest asset people have in their retirement plan.
Yes, I heard Jamie speak a couple of years ago, and he made that same claim of like, and he made it to a room full of financial planners of like, if you're if somebody is paying you an annual fee to manage their assets and you're ignoring the largest one, like there's some liability there. Yeah.
Yeah. Actually, on this channel, if you guys are interested, we have another interview where a loan officer helped her dad into a reverse mortgage. He had gone to his financial planner. His financial planner said, "No, don't do that. You don't need that." He came back to his daughter and said, "Oh, he said I shouldn't do it." And then he marinated and he said, "You know what? I want this. Why wouldn't I have this?" And went back to his financial planner and like scolded him. He's like, "This enhances everything I'm doing. Why wouldn't you have suggested this?"
It's funny you said something there that I think we should bring to attention. You said like I don't need this. He may not have needed it, but it doesn't mean that it didn't provide him tremendously more benefit than had he not done it. And that's I think what we need to get away from is we're still I find it with most planners I talk to and most calls I get are about people who are kind of in a position where they need it. And we're ignoring the people who would would be able to really enhance their retirements, but may not actually ever need it.
Well, we
Those,
can help them never need it. If they
yeah,
implement it early, they would never get to that point.
right. So I guess where I'm saying is, what if you had somebody who had like $4 or $5 million in invested assets? Odds are they're never going to exhaust those funds, and they're never really going to probably be in a position where they have to do a reverse. But boy, if they set one up early and let that line of credit grow, and like say they had a year where their portfolio was down and they didn't draw from it and left their money reinvested, um, they might find themselves when they pass away, um, leaving a pretty sizably larger estate to their heirs. And that's something else you touched upon about like, oh, people who don't have any heirs when we're talking about foreclosures. Like people who have heirs should do a reverse mortgage because they care about the next generation, not in spite of having heirs. Like
Thank you
it's
for saying that. Please
it
elaborate because
okay.
everybody needs to hear this. We know it, we see it, but they
Yeah.
don't.
All right. So I would pose a question of what would you rather have as like, your parents pass away and you're the executor of their estate. Would you rather have scenario A where they own a home free and clear and say the home's worth $600,000, um, but they have like no other invested assets, just the house, but you inherit the house free and clear? Or would you rather inherit a $1 million portfolio and a same $600,000 house that's carrying a $200,000 mortgage on it, right? Most people are hyper focused and they have blinders on. They don't see the full picture. They say, oh man, there's a reverse mortgage on this house. Man, I got to pay off this $200,000 balance. I thought I was going to inherit it. Now I got to pay this balance off. But they don't see, or they were never included, or most people won't find themselves in this situation yet because the research is so new. But that the only reason they have that $1 million sitting over there is because their parents strategically use the home equity to preserve that portfolio.
It's been proven.
It's been
There's
proven.
another
Yeah.
video where somebody says this is the actual math, and they show the two situations, like two
Yeah.
next door neighbors. One does this, one does this, and the one who does the reverse early has a ton to leave to his heirs. The one who did the reverse as the last resort, spend everything that you have, and then maybe we'll look at a reverse, had just that little bit,
Yeah.
you know?
It's sad because it's like it's right now we're kind of on the cutting edge, right? Of some of us know this, and we are trying and trying and trying to like kind of shake off this myth from people. But the truth is that it's going to take time, and it's the hard work. Like we were talking about Dave Ramsey, he's taking the easy route. He's telling people what they already believe and reaffirming what they already believe, even though it's wrong, because it's easy. We have the hard job of educating people on why what they've been taught for 40 years is wrong. And the people who listen to us 20 and 30 years from now are going to be in such a better position than the ones who didn't. And it's just unfortunate that the myth is so persistent, because it really is. When we look at even like the young boomers, because now like the younger edge of the boomers are becoming eligible. And when we look at where they are going to be in 30 years, it's, the ones who strategically planned are going to be better off. And the ones who didn't are going to find themselves you're going to find these people are like, I wish I would have done this 20 years ago. I wish, when 30 years from, assuming the program is the same 30 years from now, which odds are things are going to, over time, things
Oh,
will change and adjust.
it'll
But
probably keep improving, right? If you look at the last 10 years, the program has improved so much.
yes,
I don't see a lot of room for improvement at this point. I feel like the product's really good, but who knows what they'll come up with? Maybe they'll make it even better than I could imagine.
well, I would hope so. But I'm kind of on, when you're saying it's kind of like they've improved and improved. And I feel like improvements are there's kind of like diminishing returns, right? Like
Mm.
there's vast amounts of improvement, and then you covered this much ground. Well, then the next improvement's like little. It's more incremental. But um, yeah, when I hear people too talk about reverses being expensive, I'm like, compared to what? Like, what's expensive is like when you find yourself in a position where you have to move in with your kids in your 90s because you can't afford like long-term care. Like that's expensive. Like at that, if you found yourself in that situation, you're like, oh man, you think you'd be like, I really wish I wouldn't have spent and I shouldn't even say spent, like I wouldn't have used $20,000 worth of my home's equity 20 years ago to make sure this didn't happen. Like it's not even out of pocket. Um, yeah, it's just I feel like a lot of people, they they don't realize they don't know what they don't know. It's probably the best way to put it.
Yeah.
So
And hopefully our listeners, our viewers are learning this stuff. One of the things you said I wanted to talk about too is a lot of the reverse mortgage people who actually do the reverse mortgage, once they get it, they're happy. I think our approval rate is 93% among people who actually have a reverse mortgage. The bad approval rates or the complaints come from the heirs who were left out of the conversation. Like what you were saying, they didn't understand why the reverse was done.
Yes, and I think that's so important is having the conversation with the next generation. You know, your parents are talking about doing a reverse, and I'm assuming if you're like most people in the public, you're probably a little skeptical and wondering why. Let's sit down and talk about the why. And I think if you have that genuine conversation with them after 15, 30 minutes, they're going to say, we're happy they're doing this. This is great. Yeah.
Yeah, absolutely. And a lot of the time you'll see the relief in the kids' eyes going, "Oh, thank God, I'm not going to have to start paying their bills."
Ah, yes. Yeah.
All right, Drew. Well, we are getting near the end of our segment, so I really appreciate you being on here.
Yeah, my
Two
pleasure. Thank you.
questions.
Okay.
If somebody wants to get a hold of you and work with you, how would they?
Best way is call me. My telephone number is 916-801-0505. I'm based out of Northern California. I'm licensed in California. My website, NordicHomeLoans.com, will have ways to get in touch with me there. I have a
Perfect.
YouTube channel I'm developing right now. So if you found some of this stuff interesting, I'm going to be releasing more content, and I aim to make it entertaining, dare I say, something that people are going to actually want to watch and learn something. So you can find me at Nordic Home Loans on YouTube as well.
I can attest to that. Your content is very entertaining. I love it.
Thank you.
All right. So I always ask this last question. If you could change the face of the American retirement, how would you change it?
Okay, so I'm really thankful that you told me before we started that you were going to ask me that, because I would have been deer in a headlight. So I actually thought about this. And I think if I could change one thing, I would change the mindset and the mentality from the like, I'll deal with that when I get there, and shift it to I need to prepare now for what is going to happen 15, 20, 30 years down the road. Um, I I told this story at the FPA meeting a couple weeks ago. That morning, I walked my daughter to school and I saw this kid riding his bike, and he had his helmet hanging on the handlebars of his bike. So he's riding to school with a helmet, but not wearing the helmet. And I thought that was such a perfect analogy for what we do, in that so many people are like, well, yeah, if I need it, I'll just do it when I need it. And they don't realize that like pretty much any type of preventative thing, by the time you realize you need it, it's too late. Right?
Right?
Like,
You're over the top of the handlebars going, I wish I had that helmet on.
yeah, at that point, yeah, it's too late to grab the helmet. Or, it's too late when you're about to be in a car crash to fasten your seatbelt. Or if your boat is tipping over, it's too late to grab a life vest. Um, but for some reason, right, the item of last resort. Oh, well, if you get in trouble, at that point, you put one in place, not realizing all of the, compounding growth of their line of credit that they lost out on over the previous 20 years.
Or the qualification. How many people do you look at who have gotten to this bad situation? Their credit's bad, their income's bad. They actually don't qualify for this last resort loan they thought they could for sure get.
Absolutely. Yeah. What is, what is it? Something, an ounce of prevention is worth a pound of cure.
Oh my gosh. Yes.
And I think the vast majority of people age 62 who are, of course, like living in the home that they think they're going to age in place in. It doesn't mean they're necessarily going to die in it, but the place they're going to live in for the long haul. Um, they should have a reverse. They should put one in place, because the downside of putting one in place, say they never end up needing it or don't really use it, it's so minuscule relative to the potential like benefit that they'll have. It's one of the easiest like things to weigh out. Like this, I look at it like this. Like most people's home over the past, especially if we're talking about something with a reverse, odds are they've lived in their home for a long, long time. And hypothetically, these people may have bought their home for $120,000, and now it's worth $600,000. So I would ask that person, your home has gone up in value almost $500,000. Would you give back of that 500,000? Would you give back like 12,000 bucks, 15,000 bucks to guarantee that you're going to have a happy, healthy retirement? Like that is a no-brainer. Yeah.
Well, and we're in a time, I know we're ending, but we're in a
Yeah.
time where we're actually starting to see values decline. So when we have those conversations, Mr. Homeowner, your home is worth 800,000. Would you give up 15,000 of it that you're not actually going to experience if you pass away, right? That's going to be the house's bill to pay. But in any case, when they say no, and then they come back a year later and their property value has declined to 750, it's like, you just lost $50,000 of equity. And we were only saying put 15,000 to put this in place.
Yeah.
To me, that's like mind blowing of, what do you mean it's expensive? It's gift from God or from heaven, pennies from heaven, right? Equity is not typically what they've paid in. A little bit of it is, some of it is, but a large majority in our country is just amazing investment opportunity and growth.
Yep. It's
And
the
so
only thing where, you've heard, I know we have a minute left. So the thing I always think about too is that Robert Kiyosaki thing from Rich Dad Poor Dad about like your house not being an asset, it's a liability.
Mhm.
Right. And I was super impressed with my daughter. She recognized this when I asked her that. She's like, no, your house costs money. You got to pay a mortgage. You got to pay. She's 12. That's pretty high level for a 12-year-old to figure out. But it is kind of a hybrid. You can make the argument of both because it does appreciate in value. And the thing is that you can't realize that, that growth and appreciation until you sell the house. And then you're still left with the challenge of you still need a place to live. And the reverse and the HECM in particular really allow people to have their cake and eat it too. Still get to have the roof over their head. They still get to have the home where all their cherished memories and everything that a home provides, but they're able to have that and convert that that stored equity and be able to use it. It's the only way they can do it without selling the house
or incurring a new payment, right?
or
Because
incurring a
we
new
could do a
payment, right?
HELOC, we could do cash out, but gosh, do you really want to have a payment in retirement? Isn't that the goal, to not have
It
that?
will, yeah, exactly. So I guess in theory, it's the only way you can do that without incurring, like you said, a new liability.
Yeah. Yeah. Well, thank you so much, Drew. I think we could go on for another 2 hours, so we might have to do another session for
I would
everybody.
love to anytime. Just let me know.
All right. Awesome. And thank you guys all for watching. We'll see you on the next one.
All right, bye.
Bye.